Good morning, everybody, and welcome to our release of full year and fourth quarter 2023 performance results for FDIC insured institutions. The banking industry has shown resilience after a period of liquidity stress in early 2023. Full year net income remained high, overall asset quality metrics were favorable, and the industry's liquidity was stable. While the banking industry reported a modest decline of 2.3% in full-year net income, 2023 earnings of $257 billion remained well above the levels reported before the pandemic. The industry's net operating revenue crossed the $1 trillion mark for the first time in QBP history, and the full-year net interest margin was 3.3%. That's the highest reported margin since 2019. Nevertheless, these positive top-line results were offset by higher non-interest expense, provision expense, and realized losses on securities. Looking at quarterly results, the banking industry's net income declined 43.9% from the prior quarter, in large part because of several non-recurring, non-interest expenses recognized by large banks during the quarter. The largest contributor to the decline was the expense related to a special assessment to recover the estimated loss to the Deposit Insurance Fund attributable to the protection of uninsured depositors following the failure of two banks last spring. Some banks also reported substantial charges for goodwill impairment and also litigation, reorganization, and other one-time expenses. All totaled, these expenses made up about 70% of the quarterly decline in net income. The industry also reported higher provision expense and lower non-interest income when compared to the prior quarter, which contributed to the decline in net income as well. Community banks reported a quarterly decline in net income of 9.9% as higher non-interest expense and higher provision expense more than offset higher net interest income. After increasing slightly last quarter, the industry's net interest margin declined modestly in the fourth quarter. The decline occurred as greater interest expense on deposits and non-deposit liabilities more than offset an increase in asset yields. The net interest margin for community banks didn't change from the prior quarter. Unrealized losses on available for sale and held to maturity securities fell by 30.2% to $478 billion in the fourth quarter. A decline in unrealized losses on mortgage-backed securities resulting from lower mortgage rates drove this overall decline. The positive revaluation in bank security portfolios, along with higher cash balances, also provided a boost to bank liquidity levels in the fourth quarter. The industry increased its total loans by $107 billion, or 0.9% in the fourth quarter. That's up from 0.4% last quarter. Seasonal growth in credit card loans was responsible for most of the increase in the quarterly growth rate. Even though the quarterly loan growth rate was the highest reported in 2023, the industry's year-over-year loan growth rate declined throughout the year and was 1.8% at year-end. Loan growth at community banks was more robust, increasing 1.8% from the prior quarter and 7.8% from the prior year. Asset quality metrics were favorable overall, although deterioration is evident in commercial real estate loans and credit card portfolios. The industry's non-current rate increased 4 basis points from the prior quarter to 0.86%, a level that's still well below the pre-pandemic average non-current rate of 1.28%. The increase in non-current loan balances was greatest among CRE loans and credit cards. Weak demand for office space is softening property values, and higher interest rates are affecting the credit quality and refinancing ability of office and other types of CRE loans. As a result, the non-current rate for non-owner occupied CRE loans is now at its highest level since first quarter 2014, driven by portfolios at the largest banks. Similarly, the non-current rate for credit card loans is at its highest level since the third quarter of 2011. Driven by write-downs on credit cards and CRE loans, the industry's quarterly net charge-off rate increased 14 basis points to 0.65%, a rate that is 17 basis points higher than the pre-pandemic average rate. Now, domestic deposits increased for the first time in 7 quarters, driven by growth in time deposits. The industry's insured deposits increased by $47 billion, or 0.5% in the fourth quarter. Uninsured deposit growth was masked by one large bank that eliminated a significant amount of intercompany deposits. Excluding that bank from the calculations, the industry increased uninsured deposits in the quarter by $92 billion, or 1.4%, and that growth was widespread among bank size groups. This would have been the industry's first increase in uninsured deposit levels after 7 consecutive quarters of decline. The deposit insurance fund balance was $122 billion at year-end. That's about $2.4 billion higher than at the end of the third quarter. The reserve ratio of the fund, that's the ratio of the fund balance relative to insured deposits, increased by 2 basis points to 1.15%. The reserve ratio currently remains on track to reach the 1.35% minimum reserve ratio by the statutory deadline of September 30, 2028. So, in conclusion, the U.S. economy sustained growth in 2023 that exceeded expectations, and the banking industry remained resilient after a period of liquidity stress early last year. However, the banking industry still faces significant downside risks from the continued effects of inflation, volatility in market interest rates, and geopolitical uncertainty. These issues could cause credit quality, earnings, and liquidity challenges for the industry. And in addition, deterioration in certain loan portfolios, particularly office space and other types of CRE loans, warrants monitoring. These issues, together with funding and earnings pressures, will remain matters of ongoing supervisory attention by the FDIC. That concludes my remarks. Thank you very much for your attention. I'll be glad to take your questions.
Thank you, Mr. Chairman. And I'll take your questions. Dan, please use the raise your hand feature and I'll call on you by name. Our first question is from Pete Schroeder at Reuters. Pete, go ahead.
Hi, thanks so much for doing this. Chairman Gruenberg, Chair Powell said yesterday that he anticipated broad material changes to the Basel III endgame proposal and seemed to indicate that it would be responsive to industry concerns about the cost and impact. Is that your expectation as well?
Well, look, we've gone through an extensive process here, the banking agencies have, of issuing an NPR last year for public comment. We received the comments on January 16th. We received a lot of comments. I believe it's over 400 distinct comment letters. And the agencies are in the process of carefully reviewing all of the comments. And I certainly think we anticipate making changes in the final rule based on the extensive comment that we've received.
Thank you, Pete. Our next question is from Lauren Say at S&P Global.
Hi, thank you for taking my question. PNC disclosed a couple days ago that they were notified that the latest DIF loss estimate is 20.4 billion. Just wanted to ask if that was accurate or if there was a more updated estimate. Also, I know the FDIC has said that it's going to sway as assets are sold and they're satisfied and expenses incurred. But can you give any color on what is causing that?
Yeah, I had a little difficulty hearing the last part of your question, if you wouldn't mind repeating it.
Yeah, just asking for color on the reason for the increase.
Oh,
I
sure.
do know that you all have said that it will sway as you have been thinking.
Sure. Listen, thanks for the question. Since, as you know, when we exercised the systemic risk exception last year for the two failed institutions, and under the law, the coverage we provided to uninsured deposits has any cost to the deposit insurance fund, just to provide the background for doing that, has to be paid for out of a special assessment imposed on the industry. That's as required by law. And we implemented the proposal for that special assessment last year. And we indicated from the outset that the special assessment, the estimate of that, would change as we proceeded with disposing of the assets of the failed banks and get more clarity on the valuation of the assets. So our initial estimate last year for the cost of the industry of the special assessment, I believe, was 16.3 billion. We revised that estimate upward recently, as you indicated, to 20.4 billion. We've notified all the institutions affected, and we've also indicated that as we move forward with this process, there may well be further valuations as we proceed. So that's really the background on that.
Understood. Thank you.
Sure, thank you.
Our next question is from David Hollerith at Yelp Finance.
Hi, thanks as always for doing these press conferences. I did want to ask on the commercial real estate portfolio deterioration. You had said the office segment and then also other parts of commercial real estate loans in the U.S. And I was just curious if you could give more color on that, whether you're seeing any sort of deterioration in multifamily or construction loans and sort of how you're thinking about that.
No, thanks for the question. We've indicated for some time that commercial real estate is a particular focus of supervisory attention by the FDIC. The banking industry has broad exposure to commercial real estate, and in a rising interest rate environment, those exposures can prove challenging for the institutions. And in the release this morning, we've indicated that in regard to non-current rates and charge-off rates of CRE assets have been particularly impacted. I think you have to look at it on an institution-by-institution basis, and it's very much a function of the particular institution and the quality of the underwriting. But as a general proposition, in the current environment, this is a downside risk for the industry and has certainly been a high priority for the FDIC and the other banking agencies in terms of our supervisory work.
Thanks, David. Our next question is from Evan Weinberger at Bloomberg Law. Go ahead, Evan.
Hi, thanks so much for taking my question this morning. Chairman Gruenberg, there recently was a big announcement of a bank merger a couple of weeks ago. Just curious where the agencies are on developing merger guidance right now.
Oh, thank you for the question. As you know, that's been a matter of attention by the banking agencies. It's certainly been an area of attention for the FDIC. As you know, we issued a request for information to solicit input on how the FDIC reviews bank mergers under the statutory factors of the Bank Merger Act. And we do anticipate updating our statement of policy on the Bank Merger Act, and that's something we're quite focused on. So thank you for the question.
Any sense of timing or direction that you guys are moving in?
Stay tuned, I guess would be my only guidance to you right now.
Okay, thank you.
Sure.
Thanks, Evan. Katanga Johnson from Bloomberg. Go ahead, Katanga.
Thanks so much, Chair Gruenberg, for taking time today. The agency's problem bank list grew substantially this past quarter, even higher than I think the first quarter of 2023, where it grew by 4 banks. So it's sort of doubled since the last time it was a big worry. Does this concern you in any new way? And what's the agency's plan to sort of get banks that are on that list off that list?
As you indicated, I will say an increase of 4 institutions on the problem bank list at this stage of the economic cycle is not a large number, but given the stage of the cycle we're in, frankly, it would not be surprising to see an increase in the problem bank list. So I think at this stage, the numbers are not particularly alarming, but I think it's something we'll be paying close attention to over the coming quarters. So it's a fair question to raise.
Go to our next question. Steve Gandel of Times.
Hi, can you hear me?
I can,
you can.
Steve, thanks.
So you're seeking more information from banks on loans to non-depository institutions. What are you seeing on delinquencies in those loans? And are they rising? And do you think banks are adequately reserved for that category of loans?
I'm sorry, which category, Steve, are you referring to?
Loans to non-depository financial
Oh, to non-bank financial institutions?
Shadow banks.
Yeah, I mean, that's a matter of attention for us. The exposure of the banking industry to non-bank financial institutions is something that we pay close attention to. The specific numbers on that you ask about, if you don't mind, let us check on that, and we'll come back to you with the particular data. But it's an important area for us to pay attention to, and it's very much a focus of our supervisory efforts. So thanks for raising it. And we'll get back to you on the numbers.
Evan, I see your hand is still raised. Did you have another question?
No, just forgot to take it down.
Me too.
Any other questions regarding today's quarterly results? Katanga, go ahead.
It isn't necessarily related to today's quarterly results, but just thinking more broadly. Chair Gruenberg, you did mention that the agency is efforting to update its guidance on bank merger rules. I wanted to ask about if you could comment at all on imminent liquidity rule or ways in which the agencies are planning to address that matter. Is there a way that you'd rank which one might be taking precedent? Liquidity, bank mergers, I know they're all important. How would you rank where you are on either?
I agree. Look, I agree they're all important. I think the agencies have signaled that we're certainly focused on liquidity issues, particularly in light of the experience last year. And I think the agencies are anticipating looking at changes in our current liquidity rules in regard to the liquidity coverage ratio, and are also looking at issues relating to bank access to the Fed's discount window and potentially the prepositioning of collateral at Federal Reserve banks in order to assure access, particularly during times of stress. So I think that's something we have been looking at, and I think the liquidity issues, capital issues, and I'd also mention, as you know, the agencies have proposed a long-term debt requirement for regional banks, which I think is very responsive to the resolution issues that we experienced in the spring of last year. So I think those are three core priorities for us, and I expect we'll be acting on those.
Any concerns? A lot of our readers are sort of watching the clock and thinking about the election this year. That may or may not affect the way you're thinking about proposing measures, but are you concerned about timing it all and getting it all done?
I think these are important rulemakings for the stability and resilience of the system. So, it's certainly our intention, I think, to follow through.
Thank you.
Thank you. Steve Scandell at the Financial Times.
Thanks for taking another question from me. My question was on reciprocal deposits. They hit a new all-time high, up again, although up slightly less than before. New York Community Bank, which has been in the news, have reported that their reciprocal deposits went up a lot as they ran into difficulty, something they relied heavily on, or relied more on than they had in the past. Do you have a comment or thoughts about how you all are looking at this, the rise of this kind of new category of deposits, relatively new, I guess?
I was going to say, we're not that new. I mean, they've been around for quite a while. As you know, as a percentage of system deposits, reciprocal deposits are still quite small, but they have been growing, and I think increasing since the failures of last year. So it's something we pay attention to as we monitor the liquidity profile of institutions, it's a source of insured deposits for institutions, but something we still follow quite closely. So fair point to raise, it seems to me.
We probably have time for one or two more questions. So I'll go back to Evan Weinberger at Bloomberg Law.
I had my hand up on purpose this time. So the CFPB just released new restrictions on late fee caps. There's other fee caps that they're developing, and the Fed is working on its debit interchange. Do you have any concerns about how all these restrictions on fees might affect bank performance?
What was the first fee that you referenced? Because I couldn't quite hear that.
Credit card late fee.
Yeah. I mean, the short answer is no. I think the banks do rely on these fees, but it's also important, obviously, to keep these fees tied to the services being provided. So as a general matter, I think these are prudent consumer protection measures, and will allow the bank certainly to collect fees, appropriate to the services they're providing. Sure.
Okay, well, we will conclude our live stream with that. Press are welcome to remain on the line. We have senior staff with us to answer any additional questions that you may have.
Listen, thank you all very much. Appreciate your attention. Take care.